Hi everyone, welcome. My name is Chris Farrell and I'm an adult and seniors programmer at the Brantford Public Library. I will be your host today, and Robin Harding, our adult programming coordinator, will be attending the session also. I would like to thank everyone for joining us today for the third and final webinar of our financial retirement series. Just a few housekeeping details before I introduce our speaker today. All of you will be able to view the speaker and host, but we'll have your audio turned off until the end of the session. There are two options for asking questions. One is you can put it in the chat, or two, you can click on the raise your hand function. Just keep in mind that we are being recorded. Our webinar today is called Death, Taxes, and Beyond. And joining us today is Amanda Martin, a financial educator with the Counselling Society. Amanda has several years of experience and is passionate about building strong community relationships and inspiring others to develop good money management habits. If any of you joined us on our two previous sessions, you will find the information Amanda gave us very helpful. And now I'm happy to introduce Amanda Martin. Welcome, Amanda.
Great. Thank you so much, Chris, and welcome everyone. And thank you for welcoming me into your spaces this afternoon. Today, we're going to be talking about the ever super exciting death, taxes, and beyond. So I joke a little because the topic in itself is sounds perhaps a little morbid, or some of those things that many of us don't really like to talk about. But I assure you, these are really important things, and you're going to get some great information today. We are going to make these slides available to you after our session here today via email. So you'll get a copy of the slides as well as some additional resources that I'll make sure that you have electronically. So you can keep an eye on your inbox for those within the next day or so. Now, for those of you who may not be entirely sure of who we are and what we do as an organization, the Credit Counselling Society is a registered nonprofit charity, and we provide free and confidential credit and debt counseling for Canadians across the country. Since opening in 1996, we've helped over 500,000 people learn how to solve their debt problems, manage money better, and use their credit more responsibly. We do this in a few different ways by providing free and confidential credit and debt counseling. You can access these services by calling the 800 number that you see on the screen here and making an appointment to speak with one of our counselors. Again, remember that's free and confidential to do that, and you can ask them anything from questions about budgeting or credit, or more specifically, seeking advice or questions about your own personal finances and situation. We offer budgeting assistance, information and referral services, money management education, as well as different types of webinars and workshops like the one you're attending here today. And for those struggling with their debt load, we also have debt management and repayment programs available. Again, that 800 number that you see on your screen there is how you can access any of those services. Now, before diving into today's agenda, I would like to clarify that I am not an estate lawyer or an accountant, but I can and will certainly be providing you with some resources and preliminary information around organizing your finances, dealing with taxes, insurance, and estate planning. By the end of our time here today, my hope is that you'll be able to understand the importance of organizing your finances, the basics around filing your taxes, the different types of insurance available to you, as well as the basics of estate planning and why it's so very important. So let's start with talking about organizing our finances. Why is this so important? Or do you feel it's important? Any thoughts on that? Again, please feel free to use your chat to express your opinions or share your thoughts. Many of us think of organizing things in terms of making things easier for ourselves, right? But many times when it comes to organizing our financial statements, it's actually in an effort to help those that might be left behind in the event that something happens to us or in the event that we need help. It's important to get our financial home in order because, again, if something were to happen to us, our loved ones would need to know where to find our information, for example, our insurance papers or our wills. Can you imagine if the people you love are in the thick of feeling shock and sadness over just having lost you? And on top of that, they need to scramble to find all of your documents. I imagine this would be incredibly stressful for them, to say the least. Getting our financial home in order can really help us to declutter and reduce our own stress. It can help us to find important papers quickly and easily if needed. And I can tell you from firsthand experience, I know I was a party of a few different automobile accidents, unfortunately, a few years back. And the fact that I had my important documents in order was very, very helpful in that situation. And I was very grateful to have had those things available to me quickly. It can also help you to get in and stay in control of your finances. Sometimes, with lack of some sort of system to get organized, we can miss things or have bills that might fall through the cracks. And of course, it can simplify any tax or estate issues. Revenue Canada asks us to keep things on hand for several years because they may come back and ask us for supporting documentation at a later date. We'll talk about that later. But again, that's just one example of why it's important to have your financial home in order. Now, getting organized doesn't have to be a complicated process. If we're being honest and real with ourselves, chances are if our finances or our documents aren't in order, it's because we either probably have been procrastinating or haven't had time, or maybe we have a buildup and it might feel a little bit overwhelming to actually start to tackle. I find the best way to get on top of these things is just to take the process and break it down into bite-sized, manageable steps and pieces. We normally encourage clients to give themselves at least a month to get themselves organized. And that way you can do it one bit at a time without getting too overwhelmed. You want to start by gathering your documents and then, of course, deciding which ones you're going to keep and which ones you're going to get rid of. You might want to consider getting rid of any household bills or statements that you don't need for your taxes after 12 months. Or if there's no concerns with any of the payments, once you've reviewed it and had your payment posted, you may want to dispose of it at that time. Again, these things will what you'll have to consider as you're gathering all of your documents together. Now, the second step in this plan, you might take this as each step taking you a week to process. Maybe the second week, you would create a filing system. When you create a filing system for yourself, consider whether you want that system to be a paper system or an online system, and also consider the pros and cons of both. For example, a paper system could become a fire hazard or might have actual physical documents that people could steal, whereas online system could run the risk of infected virus or malware on your computer. Either way, you want to be sure that you have a system, and it may very well be a combination of the both as well. You're going to want to organize all of the documents that you've gathered into folders based on category. And in just a moment, I'm going to give you some examples of the different categories that you might choose to file your important documents by. You might want to keep any paper documents that you have in a fireproof filing cabinet, or you may want to ensure that you have protected any of your online or virtual documents from being accessed by third parties, and ensure that you have antivirus software on your computer or a backup copy on an external hard drive. Securing your documents is really important. As we know, all of the important financial and household documents that you might have contain sensitive information, like perhaps our social insurance number or information about banking or other items that might be private. When not stored securely, this information could be accessed in order to commit fraud. So we want to make sure that we keep all of our important things with our sensitive information secure. Now, when it comes to our filing system, some potential folders you could create as part of organizing your documents could include the ones that you see here on your screen. But by no means do you have to have all of these. You just need to have the ones that make sense to you and your family or your life circumstances. A really great recommendation from a client once had was to create a legacy drawer at home where all of your important documents are filed in that particular drawer or space. So in case of an emergency, your loved ones will know exactly where to go to grab all of the necessary documents. Again, these potential folders that you see here, you might have a physical file folder for each of the documents, or you might have a virtual file folder on your computer to store all of your virtual electronic documents. So moving on to the next part of today's webinar, let's talk a little bit about taxes. That's going to be top of mind as our tax season is in full swing and coming due next month. But why do we pay taxes? Where does our money go? Remember, our taxes pay for our health care, our education system, support for the elderly, as well as municipal and federal benefits and programs that we might be able to take advantage of as Canadians or residents in Canada. Taxes are required to be filed annually, regardless of how much money you make. Taxes outside of last year was a little bit of an exception, 2020, because of the pandemic. However, normally taxes are due to be filed on or before April 30th. If you have business or self-employment income, then that deadline is sometime in mid-June. Now, regardless of whether you owe money or you don't owe money, there is a late filing penalty that will be applied if you owe any taxes and have filed after April 30th. Now, any unpaid personal or self-employed taxes that are due by April 30th and unpaid at that time will start to get interest charged on those balances. So essentially, if you owe any outstanding taxes, you will be required to pay it by April 30th. Now, if you pay afterwards, you'll be charged interest. But as long as you filed on time, there will be no penalty. If you don't owe any taxes, you're not legally obligated to file taxes, but you will also likely not be eligible for any benefits. You see, that's how our government determines what benefits we're eligible for through our income tax assessment. So even if you can't pay for your full balance owing on or before April 30th, you can avoid that late filing penalty by making sure that you file your return on time. Now, this next bit of information comes directly from Revenue Canada. Remember that if you have a balance owing for the previous year, you will be charged compounded daily interest starting on May 1st on any unpaid amounts owing for the year before. This includes any balance owing if they reassess your return. In addition, Revenue Canada will charge you interest on the penalties starting the day after your filing due date. The rate of interest that they charge can change every 3 months. So there's a lot more information on this on Revenue Canada's website. So I do strongly encourage you to visit their website to check this out. In addition to that, Canada Revenue's website will always have the latest and most up-to-date information when it comes to your taxes. And I'm just going to type in the chat here. Canada.ca is the website that you can go to. If you type in the search, anything government related, including taxes that you need to know about, it's a really great and easy to use site, and it will take you right to the information that you need. Now, taxable income is essentially all of the things that we need to declare on our taxes. So that's our employment income, anything we earn from our wages, any self-employment or business income that we earn, any income from pensions, including Canada Pension or Old Age Security, if we've received EI or employment insurance, any income from RRSPs or RIF withdrawals, and any income that you receive from capital gains, dividends, any interest income or rental income. So this includes all sources of income like your salary, wages, and tips. If you're self-employed or a sole proprietor, you would have to declare your business income minus your expenses. So that's what we have to declare to our government. Now, with regards to possible deductions, this is a very brief look into what could be considered a possible deduction. Now, these items might be RRSP contributions if you've made any deposits into a registered retirement savings plan throughout the tax year, any professional or union dues that you've paid, child care expenses, any expenses related to an adoption or moving or investments. A deduction is basically an amount deducted from the tax that you owe based on your taxable income. And again, for more details on deductions, it would be best to speak with an accountant, or for your own references, you can again seek out that information on the Canada Revenue website. Now, tax credits could include the following. Things like medical expenses, any interest that you've paid on student loans, charitable donations, political contributions, the Gst Hst credit, and the working income tax credit. Now, taxpayers may qualify for any of these tax credits if your income is below a certain threshold. Now, let's break some of these points down a little bit. A non-refundable tax credit reduces the federal tax that you owe, but doesn't create a tax refund. A refundable tax credit reduces the amount of tax and can also help get a refund. So when we go down the list and look at medical expenses, interest, charitable donations, and political contributions, those are all refundable tax credits. The Gst Hst credit, though, is not a form of credit in order to reduce taxes. This is a credit offered to taxpayers after it's determined that their annual income is below a certain threshold and that they should be reimbursed for the Gst Hst they paid over the course of the quarter. The working income tax credit is similar as well in that it uses the word credit, but it's given to taxpayers who have employment income in a year, but it's below that certain threshold again. This credit is given to boost the income and keep people in the workforce. Again, for any details on any of these credits and for whether or not you might qualify for a particular tax credit, we encourage you to visit canada.ca so that you can get more information on these credits and your taxes. Now, my father, in all of his wisdom, encouraged me a long time ago to put any tax credit I might receive into a tax-free savings account or a registered retirement savings plan. Now, if this is an option that is available to you, it's a good idea to consider whether your chosen account is tax sheltered, whether you'll be taxed upon withdrawing it from the upon withdrawing it from the account in the future, and whether or not it will reduce your present day taxable income. It would be best to speak with a certified financial planner or an investment specialist to assess which financial vehicle would be best for you to invest in. But in the meanwhile, here's some very basic and preliminary information on some differences and similarities between TFSAs and RRSPs. Now, a TFSA does not reduce your taxable income. The interest that you earn on your savings is, however, tax sheltered, but when you withdraw it, it will not be taxed at that time. Now, a registered retirement savings plan, on the other hand, will reduce your taxable income in that tax year that it is deposited. It is tax sheltered, so the interest you earn on it will not be taxed until you choose to withdraw it. So your RSPs are taxed at the time that you withdraw from the account. Now, with regard to tax returns, these pertain to documents which contain any number or amount that you have declared on your tax forms. So these documents can include your notice of assessment. The notice of assessment is the form that you get back from Revenue Canada after you filed your taxes. It's the form that will confirm whether they agree with what you've sent them or whether they've made any adjustments to your return. You'll need to keep a copy of the tax return forms that you've submitted, as well as any T-slips or receipts. So quite often these days, with all the electronic filing, we're not necessarily required to send in all of the actual physical receipts that we have for our return. However, we do need to keep them. And it's really important that accurate annual tax filing and keeping a hold and maintaining these good records is important because, again, Revenue Canada can come back up to 6 years later after you filed and ask to see the supporting documents to the tax return that you filed. So even if you don't have to attach those receipts when you file your return, you do need to keep them on hand for 6 years. I know many people ask me in this session, isn't it 7 years? Because the rule of thumb at one point used to be you had to keep your previous tax returns for 7. Currently on the Revenue Canada website, it does say 6 years. However you do, of course, what makes you feel most comfortable. I know I have a colleague that has saved every single tax return he's ever filed in his life, and that's what makes him comfortable. So as long as you have the space for it, you do what makes sense for you. But certainly at least 6 years worth of the records is what's required. Now, speaking of the Canada Revenue Agency, if you are owing the government any money, it is a best practice to try and pay it back as best you can. If you do not file your taxes, if you owe money and don't make payments, Canada Revenue Agency can make your life difficult. They have the right to place a lien on your home, freeze assets or accounts, and garnish your employment income. Now, it is important to also remember, though, that Canada Revenue is willing to work with Canadians to get their taxes back on track. So if you've made a mistake, if you haven't filed in past and need to catch up, or if you owe an amount but can't pay it all at once, if you reach out to them, tell them what's going on, try and make an arrangement or show that you're making effort towards making payment, they will work with you. You can always set up an appointment to speak with one of our credit counselors here at the Credit Counselling Society about a potential payment plan that you can then propose to the Canada Revenue Agency. Typically, when you tell them that you've spoken with a credit counselor about how to pay back your debt, the government will see that you're taking the responsibility of paying back this debt seriously, and they can be more open to having this discussion with you. The CRA can provide you with different forms of support, which can include canceling or waiving penalties or interest, or creating a manageable plan. And they can assess whether you're eligible for any relief provisions as well. Keep in mind that the government does not need to go through procedures that lenders or banks need to go through before placing a lien on your home, freezing your accounts, or garnishing your wages. Now, if you have income from CPP, disability, or social assistance, your wages and accounts cannot be frozen or garnished. Now, if you haven't filed your taxes in past years, or if you've perhaps made some mistakes in filing in the past, as I said, Canada Revenue wants you to correct these things. So they have what's called a voluntary disclosure program where you can voluntarily file or correct your return under this program and then pay only the tax owing plus the interest, but without those penalties. If the government doesn't know what your income was last year, they'll be delayed in giving you any benefits for which you might be eligible as well. Up-to-date taxes ensure your subsidies and benefits are not delayed or stopped. Those might include a guaranteed income supplement, a Canada Child benefit, a GST or HST credit or rebate, and the working income tax benefit. Remember, when you're filing your taxes, you want to be sure to wait until you get all of your paperwork in from all of your income sources before filing so that you don't have to file amended documents. The working income tax benefit is actually, as we talked about before, it's a refundable tax credit that provides tax relief for eligible working low-income individuals and families. You can look into this on Revenue Canada's website, or again, talk to an accountant if you'd like more details on this information. If you're choosing to file your taxes on your own, you can use the traditional paper system, of course, or you can net file directly with the government if you're using an online or software program. If you're going through an accountant, they can also use the traditional paper system, or they can file your taxes for you with the CRA through the e-file system. If you have a more modest income, you could also consider assessing a community volunteer income tax program, which can help you file your taxes at a lower cost or no cost at all for some. Again, you can find out about these volunteer income tax programs through your member of parliament, as well. Your library might actually, Chris might be able to speak to this later, might have information about different programs available around tax time as well. Or your local town hall or city hall. Again, you can, on your own, file yourself paper or through NetFile, and a tax company can pretty much file anyway except through NetFile. And of course, I'm always going to recommend, if there's any sense of discomfort or question, you want to speak with a professional about this. Ask yourself, are your taxes simple and straightforward? A lot of times those tax software programs that you can purchase are fairly inexpensive. And if you have a fairly simple tax situation, it can be really easy to do. Question number 2, are you a tax expert? Ask yourself, do you know and understand how to report all of your tax income, your deductions, and all of the potential credits that you might be eligible for? And of course, if the answer is no, then seek out some help. Basically, if you're unsure about anything related to your taxes, that's your signal to speak to a professional. I'm just going to pause here for a quick moment. Does anyone have any questions about taxes before we move on to our discussion about insurance? Okay. Again, I'm also going to make my email address available for you at the end of the session here today. So in the event you come up with any questions afterwards and we've already ended, you can send me an email and I'd be happy to help out. Now, moving beyond the topic of taxes now, let's take a look at some foundational information around insurance. Now, what is insurance? I know we all feel like we have to have it and we need it, but what is it? What does it do for us? It's basically paying money to a company for a policy that's going to protect us in the event that something happens to either you your loved ones, or your personal property. Insurance can be overwhelming because, one, there's a lot of different companies out there that offer it, but also there's a lot of different options available and a lot of different kinds of insurance. Of course, we're not the experts that are doing this on a day-to-day basis. So before committing to an insurance plan, it's important to ask yourself who and what it is that you want to protect. Is it yourself? Is it life insurance? Is it payment protection for your creditors? Or is it income protection in the event that something happens to you? Is it protection for your family? Is it your property, your home, your assets that you want to protect? Is it your estate, your future, your family's future? There are several different types of insurance out there, but for the purposes of our webinar today, we're going to focus on life insurance and creditor insurance. Keeping in mind that I'm not an insurance agent, it's important to note that the information we will go over is very general in nature. A few of the different kinds of insurance out there: there's term, whole, or universal life insurance. Creditor insurance, which again is more of a payment protection, and it's coverage that benefits your creditor as well as your credit rating. Home or renter's insurance, auto insurance, disability insurance, travel insurance, which I feel like would be really important these days given how volatile the travel environment is. And of course, we don't want to forget about our furry babies in our families, and there's even pet insurance now. Again, we're going to focus on the life and creditor insurance. There are two main types of life insurance out there that we're going to talk about, and they are term life insurance and whole life insurance. Term life insurance, you're generally going to find it has a lower monthly premium, or a lower premium for the insured amount that you have. It provides insurance for a set period of time, for a 10, 15, 20, or 25-year period, for example, typically until you reach the age of 65. The premium, so the amount that you pay for this coverage, is fixed or stays the same for the entire duration of the term that you've chosen. And in the event of bankruptcy, term life insurance is often creditor protected, meaning that it's not something that gets taken away in a bankruptcy situation. Now, when it comes to whole life insurance, there's a little bit more involved in the coverage with this, and therefore there are usually higher costs associated with it. Whole life generally stays true to its name. It covers you for your whole life, after which the policy pays out. There are different types of payment plans for whole life. Plans where you're done paying after 20 years, plans where you're done paying premiums at 85 or 100, but the insurance itself is forever. It builds cash value, and they are invested in the company that you invest with. So the growth of the policy is dependent on how the company is doing, but it's a low risk, low return investment. Essentially, the covered amount grows with inflation and can be borrowed against. And again, similar to term life insurance, your whole life insurance policy is often creditor protected in the event of a bankruptcy. Again, we're going to talk about who can help us with these decisions, but before we do that, the other type of insurance I wanted to talk about today is creditor insurance. Creditor insurance can cover life and illness, so usually accident and sickness or disability. It protects your lender or your payments, so the payments are made to your creditor and not to you. So to give you an example of the difference that I'm talking about. So for example, if you had, say, a life insurance policy, that would pay out a certain amount to its beneficiary in the event that you had to use that insurance. However, with creditor insurance, for example, say you had a car loan, And at the time that you got this car loan, you opted to have the creditor insurance that covered you in the event of accident and sickness. Let's say 2 years into my car loan, I am unable to work due to injury or illness, and I qualify for the insurance coverage that I have on my loan. That insurance money that I qualify for doesn't come as a payment to me in order to pay my bills. It actually, the amount of my payment gets paid directly to my creditor. So it helps to keep your credit rating in good standing by paying your bill while you are unable to make that payment for yourself, or while you have a reduced income for being off for whatever reason. Something to keep in mind is that creditor insurance is always required to be offered to you when you get a loan or a mortgage or a credit card or any type of credit. However, it is not legally required in order for you to borrow that money. Okay, so you don't have to take the insurance. You can look at the insurance, read all of the fine print, and certainly investigate and do your research about what coverage options are best for you. And of course, as always, speak to an insurance agent about proper coverage. Now, for details on what type of insurance would be best for you, it's best to speak with either an insurance agent, an insurance broker, or a financial planner. Insurance agents work for a company and can only sell that company's insurance policies, whereas an insurance broker, on the contrary, does not work for one insurance company, but rather they have a distributor type relationship with multiple insurance companies. This allows the insurance broker to compare several different policies on the market to choose the best fit and price for you. A financial planner, or a certified financial planner, short form would be CFP, would be someone you can also discuss insurance with. Certified financial planners are really great resources to have because they can help you take a holistic approach to your finances. They can look at your investments, your retirement savings goals. They can look at your estate planning, and as well as your insurance needs. Now, a final word on the insurance portion of our webinar for today. Having insurance gives you peace of mind. You know you're covered in the event that something happens. Insurance names a beneficiary. So in the event that something happens to you, it allows you to pass on the benefit of that insurance policy to a loved one or person left behind. Talk with an insurance professional to ensure that you're properly insured. And please do consider getting a second opinion on this. This is your life, your livelihood, and your future and your family's future. It's important to get good advice and advice that you're comfortable with. Be wary, as with anything, when there's a buy-sell scenario involved, that you want to be sure about schemes and multi-level marketing services. Do your research and read the fine print, and don't be afraid to ask questions. Again, I'm going to make my email available to you, so if there are any questions after the session, I'd be happy to answer them. You remember we were talking earlier about going back and the concept of the legacy drawer. So having that one space to have all those important things in the event that something happens. Now, it's a good idea to also create an "in the event something happens to me" document. And this can be in the event of an illness or your injury or even your death. And essentially, it's just one piece of paper that will help your loved ones to handle your affairs with information that they might need with minimal issues during a really stressful time. And just to back up a moment, I noticed that there's a question here in the chat to back up to our insurance. The question is, I have life insurance through work right now, but after I retire, what happens to that insurance? That's a really good question. Quite often, if it is a term type policy, quite often once we've finished paying into it, then that policy tends to cease to be in effect any longer. You might have the option to transfer it to a different type of policy, to reapply, or to convert it to a whole life policy if it's not already what it is. But I can't really speak to exactly what happens to your insurance after you retire, because I don't know the specifics of your policy. But if you have any questions about your work policy, I would recommend that you start getting that information by reaching out to your human resources or people and culture department, and they'll be able to give you further information or contact information that you can access for your insurance policy through work. Then you can get some more specific information about your policy. Not all policies are the same, so I can't speak to them that generally in nature. Now, we here at the Credit Counselling Society, we do have a template that I'm going to send to you afterwards electronically that is a copy of a version of that in the event of document. So we can give you an example of what that might look like. Again, remember to keep your documents secure. It's got personal and private information on it, so you don't want to be hanging it on your fridge for the whole world to see or putting it beside your computer workspace. And in the event of document should contain the following information so that your loved ones can easily locate your healthcare directive, your power of attorney, your funeral arrangements, your will, your banking information, your insurance information, any safety deposit box info that you might have, any information about foreign accounts, income, investments, or any business information as well. When it comes to our healthcare directives, there are two types of healthcare directives. One is a proxy, where someone can speak on your behalf, and one is specified, so providing checkboxes for specific situations. Healthcare directive specifies what actions are to be taken to care for your health if you're unable to communicate for yourself. It gives your loved ones and your doctors the guidance that they need in order to manage your care. Oftentimes, this is helpful if you have a long-standing illness or if you are in a vegetative state due to an accident, for example. And again, these are things that are important to get in order so that you're prepared in the event of. A power of attorney is a legal document that gives someone authority to make financial decisions for you in the event that you're no longer able to for yourself. Your power of attorney must be designated while you're still able to make competent decisions for yourself. So you can only appoint your power of attorney when you're of sound mind to do so. A power of attorney loses all of its power when the grantor loses their mental capacity, whereas an enduring power of attorney continues on even after that point in time. A power of attorney becomes invalid when you die. At that point, your executor or your beneficiaries would be the people in charge of the finances. And again, if you're unsure of who to make your power of attorney or how to go about creating this document or what the cost of this is, please do seek legal advice if you're unsure. And again, I don't mean to sound morbid, but it really is a good idea to consider pre-planning or pre-playing for your funeral arrangements. The benefits really do, again, they're helping the loved ones that you leave behind. It's ensuring also that your own personal wishes are being carried out. Prevents your loved ones from having to make more decisions at a time that's already going to have a lot of decisions and stress attached to it. I also want you to be wary of high pressure sales tactics when it comes to funeral arrangements, and do your research. As with anything else, read the fine print and know what you are signing up for. Now, connected to funerals is the topic of wills. A will basically details what is to be done with your belongings and assets once you are deceased. It can be handwritten or holographic. It could be done online. It could be done through a home will kit, or you can employ a lawyer to create a will for you. Keep in mind that the validity of these types of wills will vary and depend on which province you reside in. There's a website, I'm going to type it in the chat here. It's called legalwills.ca. And it's been online since 2003. It operates all over English-speaking Canada. It's in the process, I think, of translating also to French. But essentially, a will with this organization costs about $39.95. And the site also offers other essential services like that power of attorney and enduring power of attorney services that you might need to take care of. If you need to put someone in charge of your estate, or if you become otherwise incapacitated, and you can even put your funeral wishes in this document as well. So again, I know if you are employing a lawyer to create a will for you, those prices can vary. I know I live here in Ontario, I personally spent roughly around $500 or $600 on a will. I have a fairly simple situation. I have one child, one residence, so it wasn't too complicated. I guess the more complicated your situation gets, the greater the cost would be in creating that will, but it will vary the cost depending on lawyer and your situation. Preparing a will is a good idea for a number of reasons. A will can name your executor, so have someone in charge, and we're going to talk about who that is and what that's about, of your items and belongings after your death. It will indicate what's going to happen to your estate after your death. If you have children, your will might assign guardianship of those children if you're no longer able to take care of them. A will can help avoid additional legal costs after your death for your loved ones. And it can certainly make your loved ones' lives easier in the event that something should happen to you. So let's break some of these down just a little bit more. You have to appoint an executor in your will, and the executor will have to deal with your remains and funeral, safeguard the estate. So for example, change the house insurance if the house is unoccupied, or keep any vehicle that you might have insured. They'll gather up your assets, pay your debts, including taxes, and divide what remains of your asset among the people named in your will who are entitled to receive a share of your estate. These people are called beneficiaries. Essentially, an executor is someone you assign and trust to carry out your last wishes. You need to ensure that you have a conversation with this person about their responsibilities and your wishes. They're going to be required to execute your last will and testament, probate the estate, which we'll talk about a little bit further, wrap up your final estate taxes, and discuss your funeral and estate plans with them. Again, it's important that this person know where your "in the event something happens to me" document is located. Now, moving on to the term probate, what does this mean? Probate is the court process in which your executor is given the authority to administer your estate. So really, it's just the government's way of saying, yes, okay, we agree this person is legally able to carry out this person's last wishes. So your executor applies to probate court for a grant of probate and the approval of your will. Once it's approved, the executor can then carry out your last wishes and disperse your estate. Again, there are fees, so probate fees will vary according to province. So essentially, probate is the process through which the court certifies that your executor has the right to administer your estate. When someone dies owning an asset by themselves, for example, a bank account, a property, or a vehicle, in order to transfer the ownership or title of that asset, you must go through probate. So it's when the person applies to be the executor and obtains a certificate of appointment to carry out your will. The certificate then grants the legal authority for the executor to perform all of the duties that they need to do to carry out your last will and testament. Now, if your estate is not probated, it cannot be dispersed. When your executor tries to disperse your estate, financial institutions will want your proof of death, proof that the will is valid and that it's in its final version, proof that your executor is the person named in the will, and they will also want to know that they won't be sued if the will is contested. So that's why probate is important, especially if you have assets. Now, there's no legal requirement that your will be submitted by your executor for probate. However, in order to transfer certain types of assets upon your death, such as real estate, legal statutes require that a grant of probate be furnished. A grant of probate may also be required if a third party, such as a financial institution or bank, in order to allow your executor to manage and or transfer your assets. Even if the financial institution has the only assets that are in your estate and you only have a single beneficiary, the financial institution will still require that probate. Now, if you'd like to avoid probate and the additional fees that are associated with that, there's some important steps that you can take to include, and that would be you want to ensure you name beneficiaries on any life insurance policies or investments that you have. That way, they'll just automatically transfer upon your death. You can make sure that you have joint ownership of any assets, real estate, or belongings like vehicles. Again, if there is joint ownership, then it will automatically transfer over upon your death. Consider giving gifts prior to your passing. You can set up a trust, and of course, always seek out that legal advice to see what is the best option for you. Now, what happens if you don't have a will? The laws in your province or territory will determine how your estate's divided, and the government will also charge you a fee or charge your estate a fee to disperse it. So even if you don't owe or own anything, you should still create a will just to ease the burden of those responsibilities to those that are left behind. Another task your executor is responsible for is to handle your final taxes. They'll likely be required to complete 2 tax returns, your final return as well as the estate return. The final return is where the person is deemed to have disposed of all of the assets as of the date of their death. And the estate return is where, if your estate isn't settled at the date by the date of death, then the executor must file an annual return until your entire estate is settled. There is usually more than one tax return to be filed. Now, the last piece I want to start wrapping up with is this: what debts will pass on with you when you die? If you are the sole borrower, the debt will die with your passing. Now, that being said, creditors can still seek payment from your estate. Naming beneficiaries to your life insurance and investments can generally protect these funds from your creditors. Unfortunately, any joint debts that you have remain the responsibility of the survivor. Now, we've talked about a lot of really heavy stuff today, and I've given you a lot of information. So if any of this feels overwhelming, or if you just want to find out more, some good resources to access include an estate lawyer, an accountant, certainly a certified financial planner or a certified life insurance underwriter. And certainly you can always check out those online wills. They're valid here in Ontario. Something to consider as well before you pay for any service, access the Legal Aid Society or organization to see if there is any free services that you're eligible to access. And before I leave you with my final tips for the day, my hope is that you would be able to take a quick moment to fill out the survey here. I'm going to put the link in the chat here for you, or you can use your phone, your smartphone, to use your camera and use the QR code on your screen. But I will also send this link to you with the electronic resources we'll be sending out to you afterwards. So if you don't have a chance to do it today, please do take the time to fill that information out for me at a later date. We really do appreciate it, and it allows us to give you the information that you want and helps me to improve in relaying that information to you. I'm also going to give you my email address here in the chat, amanda.martin@nomordebts.org. That way you can email me if you have any questions that come up in the future. Some final tips before we wrap up. Be sure to keep your taxes up to date to ensure that your subsidies and benefits are not interrupted. Consider getting proper insurance to cover yourself and your family and your estate. Leave clear instructions in your will for your family and communicate your wishes with them. Of course, we have all sorts of free tools and resources on our website at mymoneycoach.ca. My hope is that now you're able to understand the importance of organizing your finances, the essentials about taxes, the different types of insurance that might be applicable to you, as well as the basics of estate planning and why it's so very important to consider this. So I thank you. I'm going to leave you with a few resources here. We have blogs and tools and newsletters with all sorts of financial information available to you. And of course, don't forget our free and confidential credit counseling. So I thank you again and would like to leave our last few minutes here open for any questions that you might have.
That was great, Amanda. While we're just waiting for questions, I just wanted to mention that Amanda will be back with us on April the 21st for a webinar on cautious consumerism. So she'll tell us about the most common scams and frauds in Canada today and what to do if you become a victim of identity theft. And just see if there's any questions.
Oh, I see someone have their hand up. You can type your question in the chat or feel free to unmute yourself to speak at this time. You have the access to do so.
No, Robin, I can't see how to unmute them. Maybe if they could type them into the chat. I can't seem to unmute them for raising your hand.
Okay, so the question here, we received a $300 check from the government. Do you know if we'll receive a T4? That's a very good question. I guess it would depend on what that money was from. Generally speaking, the government will usually send you confirmation of everything that they've given you. They're pretty good at keeping track of what they've handed out to us, but certainly I know taxes this year will likely have some sort of information about CERB or some sort of input where we put any sort of benefits that we might have received from the government. Sometimes, like with the child tax benefit, you don't have to necessarily, you don't, but yeah, you still do. You do get information on what you've received throughout the year. So I don't have a definitive answer for you on that, Carol, because I'm not sure what the money was from or if you need to declare it.
It was they gave seniors a $300 cash, whatever, in the summer. Everybody got it.
Okay. That's, I'm not sure if we're going to receive T-type slips for that kind of income that we've received, because there's been similar ones for parents with students in school and similar benefits that we've all kind of received last year, just little ones here and there. So I don't know the answer to that, Carol, and what I would suggest again is that Canada.ca website is the most up-to-date information. And if you employ an accountant at all during tax season or get support with your taxes, I would ask and pose that to your professional as well.
Thank you.
Another question here. When you have life insurance and you need money, why are you allowed to take it out in an emergency? Because if we remember, the whole life insurance acts also as an investment. So you're making money on your premiums as well. Whole life policies are created in such a way that it can create some sort of income for you. So in that sense, you always have the option to access that money, and you can borrow against it. Again, depending on your particular policy and what that entails, there will be different rules or regulations as to what you can borrow, how much you can borrow, and that type of thing. But again, you're going to want to be speaking to your insurance agent or insurance broker or your certified financial planner about those insurance questions. Because they may be able to advise you in an emergency situation which pot of money you have access to would be the wisest to use. It may be insurance, it may be other investments, it may be something altogether different. So again, you'll want to consult a professional when you're making those big financial decisions. Okay. If you have debt and you die, are your adult children responsible? No. When you die, your as we talked about, essentially your debt dies with you unless one of those children is a co-borrower. So for example, say you had a car loan and your daughter was on that car loan with you. When you die, your daughter would then be responsible for the balance outstanding on the car loan. Now, if you're the only person on that car loan, then your debt dies with you. Now, that being said, your creditor or the bank that you have the loan with can ask for the balance of their debt that's owed to them from your estate. So essentially, any debt that you have that can be claimed from creditors would be taken out of the money from your estate before it's dispersed to any beneficiaries. So, but your children are not responsible for your debt. your estate is, though. Okay. Now, I do want to be mindful of the time. So last chance for any questions that we might have. And again, I will put that email address in the chat if you have any additional questions.
Okay, if there aren't any more questions, then our session is done. I would like to thank everyone for coming today. I hope you found the information helpful. That was a lot of information. Thank you so much, Amanda. That was great. All 3 sessions were wonderful. Please check out our webinars and programs on the website for more adult programs. Thank you, everyone, and goodbye for now. See you again.
Have a great day, everyone. Take care.
Thanks, Amanda.